Welcome to the Consumer Financial Protection Bureau's field hearing in Kansas City, Missouri at the Kansas City Music Hall. At today's field hearing, you will hear from Director Richard Cordray and a panel of distinguished experts who will discuss issues related to small dollar lending. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take control over their economic lives. My name is Ixta Martinez. I'm the Associate Director for the External Affairs Division at the CFPB. Our audience today includes consumer advocates, industry representatives, state and local officials, and of course, consumers. We are especially pleased to welcome Kansas City Mayor Sly James, Acting Commissioner of the Missouri Division of Finance Debbie Hardman, and Supervisor of Consumer Credit Joe Kreider. We're delighted that you're here. Let me spend just a few minutes telling you about what you can expect at today's field hearing. First, you'll hear from Mayor James. Then CFPB Director Cordray will provide remarks about today's publication of the Notice of Proposed Rulemaking, or NPRM, to address consumer harms from practices related to payday loans, auto title loans, and certain installment loans, as well as publication of a request for information and supplemental research. Following the director's remarks, David Silberman, the acting deputy director for the Bureau and the associate director for the Bureau's Research, Market, and Regulations Division, will frame a discussion with a panel of experts. After the discussion, there will be an opportunity to hear from members of the public. Today's field hearing is being live streamed at consumerfinance.gov, and you can follow CFPB on Facebook and Twitter. So let's get started. Mayor Sly James was born and raised in Kansas City and learned valuable lessons about resiliency and dedication, watching his parents work hard to take care of their family. Despite the challenges they faced, Mayor James's father, a chef, a janitor, and small business owner, and his stepmother, who helped manage their business, still made sure that their children had the opportunity to go to a good school and follow their dreams. This laid the foundation for Mayor James' commitment to education to ensure every child receives a high-quality education, regardless of where they live or their socioeconomic background. Mayor James focuses his efforts to make Kansas City best in 4 areas: education, employment, efficiency, and enforcement. In addition, Mayor James has worked to raise Kansas City's statewide and national profile by highlighting the myriad cultural and human capital resources in Kansas City. Join me in welcoming Mayor James.
Good morning. First of all, let's thank the Consumer Financial Protection Bureau and their director, Richard Cordray, for choosing Kansas City to have this hearing. I also want to thank Communities Creating Opportunity for their leadership on this issue. CCO has worked hand in hand with the faith communities to get people in the door to testify today, and I very much appreciate that. And as we go about making Kansas City a better place to live, work, and raise a family, predatory lending is one of those things that we simply have to fix. In Missouri, there are more payday loan shops than Walmart's, McDonald's, and Starbucks stores combined. And invariably, these proliferate in areas of town where the residents are the most vulnerable and predominantly minority. That's no accident. Research suggests that payday lending practices drain $26 million a year from the Kansas City economy. That's money that our constituents could be spending on food and clothing, transportation, rent, school supplies, and other things that make their lives better. It's money they could donate to churches or other charities if they so decided. Instead, they get caught up in this inescapable debt trap because of the obscene interest rates that our state legislature refuses to address. A credit card lender can legally charge a high annual percentage rate of 36%, and that's kind of high. The average payday loan in this state has been allowed and legislatively sanctioned to rise to 455%, and that's astronomically obscene. 455%. It's not just incomprehensible, it's obscene, it's immoral, and it should be illegal. Auto title loans aren't much better. An industry that charges triple-digit interest rates on small dollar loans is not really the kind of financial service that we really want or need in this city. Payday lenders like to promote their loans as some sort of short-term solution to emergencies. But payday lenders aren't philanthropists. They're motivated by profits, not people. And they prey on those least able. They prey on those who have the fewest options. And 70% of the borrowers with payday loans aren't using it for an emergency, they're using it to try to cover basic household expenses. The payday loan shop becomes the foundation of the household budget. Pew Charities Trust, or Charitable Trust, tells us that typical payday loan borrowers have to pay almost 38% of their next paycheck just to cover the prior loan. 38% just to cover the prior loan. Now you think about it. If you're struggling already and you're having a hard time making ends meet, now you got to take 38% of that check out to cover something on a loan that's going to be with you forever. That's certainly not a good thing. Paychecks and paybacks should be limited to 5% of the loan. And that way people can pay back the loans but still have enough money to live. If they are forced to continue with the way things are, then we just create an endless cycle of exploitation. Don't have enough money to pay the loan and your monthly bills? No problem, go back to the lenders. They'll happily lend you some more. At 455% interest rates, why wouldn't they? And while we can look at these numbers and see that they don't add up to a sound financial future for anyone, numbers alone don't tell the entire story. It's almost always folks who are struggling to make ends meet and have few options who are hurt the most by payday lending, and those are the folks that you're going to hear from today. I encourage you to listen to their stories and remember them as you create a policy and talk about policies and bring transparency and accountability to these small dollar loan businesses. Predatory lending creates a cycle of debt that is virtually impossible to escape. Further, this cycle just helps keep the poor poor. It robs this city, state, and country of the potential economic contributions that people could make if they had other options at their disposal. While doing that, it also taxes social services, driving those services and the cost of them higher. While all of that is happening on the negative side of the ledger, the payday lenders just get richer and richer and richer. They put more and more stores out. We're not talking about small loans with reasonable interest rates here. That's not the point. Sometimes everybody needs to have a loan or have access to a loan. Things happen. What we're talking about are obscene, triple-digit annual percentage rates on payday loans and car title loans that hurt families in my city and across this entire country. A few $100s to fix the family car or pay for a medical bill can end up costing the borrower thousands or hundreds of thousands of dollars. In what world is that okay? These predatory lenders should more closely and strictly be regulated. For example, lenders should not be allowed to maintain access to a borrower's bank account or auto title for an unlimited amount of time. We need to make sure that all small dollar loans are actually affordable to the borrowers and that interest rates are set at a level where the borrower has a legitimate shot at paying it off. And I don't have a problem with people making a legitimate profit. That's what business is about. But 455% interest rate is by no means legitimate. We should also allow borrowers more time to repay their loans, keeping them out of that paycheck to paycheck to paycheck to paycheck cycle and debt trap. And finally, we need to cap these outrageous triple-digit interest rates. Not all of these things can be done by the people who've decided to come here to our city and talk about this and hold this hearing, the Consumer Financial Protection Bureau. They can't do it alone. Our state legislature is responsible for these interest rates. Our state legislature has some responsibility to do something about it. And I've got an idea. If we go to the state legislature and tell them that for every borrower, they can give them a gun if they lower the interest rates, they may just do that. I'm wearing my gun violence orange today. I'm not really serious. Our state legislature has to act on this situation. They have a responsibility to the people in this state not to see them exploited. If desired, they can work with the CFPB to create a more just and transparent set of regulations to guide this industry. But before they do that, they have to understand what it means for a person to be caught in this cycle of endless debt and hopeless poverty. And the way that they can do that is by listening to you today and taking it to heart. Thank you for allowing me to be here. Let's start to put some money back in the pockets of our citizens. Thank you.
Thank you, Mayor James, for the warm, welcoming remarks. I am now pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, he led the CFPB's enforcement office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta. Thank you to the mayor, to the commissioner for being here. Thank you to all of you who are joining us today. And we appreciate having so much interest in our work. We're here in Kansas City, known as the heart of America, to discuss concerns about payday lending and other types of loans made to consumers facing an immediate need for cash. We've been here before when we brought an enforcement action to shut down the Hydra Group. This was a predatory online lending scheme that maneuvered people into small dollar loans and then stripped money out of their accounts without their consent. We froze their assets and put them out of business. We also held an earlier field hearing in St. Louis on the other side of the Show Me State. There we learned about loans offered at rates sometimes as high as 1,950% annually, made to consumers who lacked the ability to repay, causing some people to roll over their loans again and again and again. Today we're here to show everyone concerned our new proposed rule on payday loans, auto title loans, and certain high-cost installment and open-end loans. In such markets where lenders can succeed by setting up borrowers to fail, something needs to change. From the beginning, payday lending has been an important priority for the Consumer Bureau. In the statute creating this new agency, Congress authorized us to exert supervisory authority from the outset over all financial companies in only 3 specified markets, and one of these is the market for payday loans. In addition, we have the authority to enforce the law against all payday lenders. We've deployed this authority in a number of cases involving both storefront and online lenders, where our investigations have found violations of the law. And we have the authority to write new rules to clean up unfair, deceptive, or abusive practices that harm consumers. That's the purpose of our discussion today. In January of 2012, just after I was appointed as the first director of the Consumer Bureau, we held a field hearing in Birmingham, Alabama, focused on payday lending. We've had others since on the same subject in Nashville, Tennessee, and Richmond, Virginia. These issues have drawn interest from people of diverse backgrounds all over this country. In addition to these public events, we have sat and talked at length with many stakeholders, from consumer groups to lenders to academics. Perhaps most telling of all, we've held numerous sessions with a broad set of faith leaders from across the country. They have shared searing experiences of how payday loans affect the people they care for every day in their churches and mosques and synagogues. And they have described how these loans undermine financial life in their communities. In devising this proposed rule, we've been listening carefully, and we will continue to listen and learn from those who would be most affected by the rule. And we will take their comments into account as we go forward and work to finalize new reforms in this area. We've also looked at the history of small dollar lending in this country. Some early examples were salary lenders who offered quick cash to consumers by essentially purchasing their next paycheck at discount rates that were very costly. These practices led to a crackdown and legal reforms designed to ensure that such loans would be made on more responsible terms. Many states, covering tens of millions of people, have maintained strict usury caps that effectively permit only small dollar loans that are carefully underwritten. The Consumer Bureau, by contrast, does not have authority under our statute to establish a usury limit for such loans, and so our proposal would not do so. More recently, other states created legal frameworks that opened the door to loosely underwritten, high-cost payday loans, auto title loans, and payday installment loans. These newer laws first arose when some check-cashing outlets began to hold a customer's personal check for a period of time for a fee before cashing it, which spawned the payday loan business. We have undertaken extensive research to understand how consumers experience these loans today. We've done so with the recognition that people who live from paycheck to paycheck sometimes need access to credit to deal with drops in income or spikes in expenses, as well as times where their income and expenses are mismatched. But at the same time, we've made clear our view that the credit products marketed to these consumers should help them, not hurt them. And our research has shown that too many of these loans trap borrowers in debt they cannot afford instead of tiding them over in an emergency. Specifically, we found that short-term loans with very high annualized interest rates offered over a short period, typically 390% or more for 2-week single-payment loans, often result in consumers frequently rolling over these loans. Nearly 4 out of 5 of these loans are reborrowed within a month, usually when the loan is due or immediately thereafter. Approximately 1 in 4 new loans results in a sequence of at least 10 loans, one after the other, made in a desperate struggle to keep up with the payments that are due. Each time, the consumer pays more fees and interest on the same debt, turning a short-term loan into a long-term debt trap. It is much like getting into a taxi just to ride across town and finding yourself stuck in a ruinously expensive cross-country journey. Indeed, the very economics of the payday lending business model depend on a substantial percentage of their customers being unable to repay the loan and borrowing again and again at high interest rates, incurring repeated fees as they go along. More than half of all payday loans are made to borrowers in loan sequences of 10 loans or more. For borrowers who are paid weekly or biweekly, 1/5 of the loans are in sequences of 20 loans or more. We uncovered similar issues with single payment auto title loans, where borrowers use the title to their car or truck as collateral for a loan. The borrower agrees to pay the full amount owed to the lender in a lump sum plus interest and fees in a short time, usually in about 30 days, to get their title back. These are high-cost loans with an annualized interest rate of about 300%. After analyzing over 3 million loan records, we found that these loans are single payment and short-term in name only. Only 12% of new loans are repaid in full when due without having to reborrow. By contrast, more than 80% of auto title loans are rolled over or reborrowed on the day they are due because borrowers cannot afford to pay them off in a lump sum. Moreover, 1 in 5 of these short-term auto title loan sequences ends up with the borrower having his or her car or truck seized by the lender because of a failure to repay the loan. When borrowers lose their personal vehicles, they may also lose mobility, which in much of the country, such as where I grew up and where we are here today, can greatly imperil the foundations of people's financial lives. For those who have to walk away from a loan without their car or truck, the collateral damage can be severe if they've relied on it to get to work or to conduct most of their daily affairs. The rule we're proposing today also addresses certain longer-term installment loans and open-end lines of credit. Specifically, the proposal would cover loans for terms longer than 45 days when the lender either collects payment by accessing the consumer's deposit account or paycheck, or secures the loan by holding the consumer's auto title as collateral. Of particular concern to us are payday installment loans. These are high-cost loans, typically made by lenders who also offer standard payday loans, with the installment payments timed to fall on the consumer's paydays and deploying these types of leverage to extract payments. Some have a balloon payment that has to be repaid after a number of interest-only payments. Our research into payday installment loans revealed that at the end of the day, after accounting for some amount of refinancing activity, more than 1/3 of loan sequences ends in default. Our study of auto title installment loans found similar figures, with loan sequences ending in default nearly 1/3 of the time. In addition, more than 1 in 10 loan sequences ended with the borrower's car or truck being seized by the lender. Currently, about 16,000 payday loan stores operate in the 36 states where this type of lending takes place, joined by an expanding number of online lending outlets. Some of these lenders also make auto title loans or payday installment loans or both. What they have in common is that they offer quick cash on terms that make it very hard for consumers to pay off the loans on time. And they've devised ways to be profitable without determining whether consumers who take out these loans can actually afford them. In the case of payday and single payment auto title loans, this business model depends critically on repeat borrowing. For payday installment and auto title installment loans, the business model depends primarily on access to a borrower's account or auto title, which provides the lender with the necessary leverage to extract payments even when the borrower cannot afford them. Based on our research and what we've heard around the country, we believe the harm done to consumers by these business models needs to be addressed. As we took up the task of proposing reforms, we spent much time and effort learning about state and tribal regulatory regimes, including many discussions with state payday regulators, state attorneys general, and tribal leaders. Payday lenders already have to comply with federal laws on matters such as truth in lending and debt collection practices. Today, the Consumer Bureau is taking the next step, adding new federal protections against lending practices that harm consumers by trapping them in debt they cannot afford. These strong common sense protections would apply mainstream lending principles to payday, auto title, and certain other high-cost installment and open-end loans. Traditional lenders, such as community banks, credit unions, and many finance companies, make an effort to determine a borrower's ability to repay before offering a loan with affordable payments. Both the lender and the borrower have a mutual stake in one another's success. But today, the borrower's ability to repay is often entirely absent from the transaction when it comes to payday and other similar loans. Our proposed rule seeks to address these concerns by protecting consumers from such debt traps. Let me first describe how the proposal applies to short-term loans. For these loans, the lender generally would need to apply a full payment test to determine that consumers have the ability to repay the loan without reborrowing. Lenders could also offer a loan with a principal payoff option, but only under specified conditions that are directly designed to ensure that consumers cannot get trapped in an extended cycle of debt. To spell this out further, using the proposed full payment test, lenders making short-term loans would be required to check up front whether the borrower can afford to pay the full amount of the payment when it comes due without needing to reborrow. Specifically, lenders would need to verify the borrower's income, borrowing history, and certain key obligations. This would determine whether the consumer will have enough money to cover their basic living expenses and other obligations and still pay off the loan when it is due without needing to reborrow in the next 30 days. The proposal further protects against debt traps by making it difficult for lenders to press distressed borrowers into rolling over the same loan or reborrowing shortly after paying it off. And it would cap the number of single payment loans that lenders can offer to a consumer in quick succession. Under the principal payoff option, consumers could borrow a short-term loan up to $500 without passing the full payment test, as long as the loan is directly structured to keep the consumer from getting trapped in debt. Under this option, if a consumer cannot pay off the original debt entirely or returns to borrow within 30 days, the lender could offer no more than 2 extensions to the original loan, and then only if the consumer repays at least 1/3 of the principal with each extension. This proposal would afford somewhat more flexibility while expressly protecting borrowers against debt traps and providing them with a simpler way to pay off their debt. To further safeguard against extended indebtedness, lenders could not offer this option to any consumer who's been in debt over the preceding year on short-term loans lasting 90 days or more. Our proposal takes the same basic approach to the longer-term loans that it covers. Here again, our proposed rule would generally require lenders to apply the same full payment test to determine whether borrowers can pay what they owe when it is due and still meet their basic living expenses and obligations. For payday and auto title installment loans, either with or without a balloon payment, this means consumers have to be able to afford to repay the full amount when it is due, including any fees or finance charges. Our proposed rule would permit lenders to offer certain longer-term loans without applying the full payment test if their loans meet specific conditions designed to pose less risk to consumers and provide access to responsible credit. In particular, we're not intending to disrupt existing lending by community banks and credit unions that have found efficient and effective ways to make small-dollar loans to consumers that do not lead to debt traps or high rates of failure. Indeed, we want to encourage other lenders to follow their model. Therefore, our proposal would not require lenders to apply the full payment test for loans that generally meet the parameters of the kind of payday alternative loans, known as PAL loans, authorized by the National Credit Union Administration. For these loans, interest rates are capped at 28%, and the application fee is no more than $20. This option would be available to all lenders on the same basis and not just to federal credit unions. Our proposal also would not require the full payment test for certain installment loans that we believe pose less risk to consumers. These loans would have to meet 3 main conditions. First, they must be for a term of no more than 2 years and be repaid in roughly equal payments. Second, the total cost cannot exceed an all-in percentage rate of 36%, plus a reasonable origination fee. Third, the projected annual default rate on all of these loans must not exceed 5%. The lender would have to refund all of the origination fees paid by all borrowers in any year where the annual default rate of 5% is exceeded. Lenders would also be limited as to how many such loans they could make to a consumer each year. The Bureau is also proposing new requirements to address how lenders go about extracting payments from consumer accounts for the type of loans covered by this proposal. From our research, we found that when these attempts failed because they were returned for insufficient funds, online payday and payday installment lenders often made repeated attempts to extract money electronically, even though they were unlikely to succeed in doing so. When these attempts repeatedly fail, consumers risk incurring substantial fees, both for insufficient funds by their bank or credit union and for return payments by the lender. Some lenders even break up the total amount they're owed into smaller chunks and feed them through the system piecemeal, even though one payment will rarely succeed when another fails. This can lead to multiple penalty fees being assessed on what started out as a single payment, hiking costs for consumers while typically failing to collect any more money. Our research also found that many online payday borrowers lost their bank accounts after one or more failed attempts by a payday lender to extract a payment from the account. For the loans covered by our proposal, lenders would have to give borrowers advance notice before accessing their account to collect a payment. This would give consumers a chance to question or dispute any unauthorized or erroneous payment attempts and to make arrangements for covering payments that are due. We believe this will reduce the risk of consumers being debited for payments they did not authorize or losing their accounts as a result of debits they did not authorize or anticipate. In addition, we propose what we call the debit attempt cutoff. After 2 straight unsuccessful attempts, the lender could not make further debits on the account without reaching out to the borrower to get a new and specific authorization. This would keep consumers from being slammed by multiplying fees for return payments and insufficient funds. Under all aspects of the proposal we're releasing today, we recognize that consumers may need to borrow money to meet unexpected drops in income or unexpected expenses. We recognize, too, that some lenders serving this market are committed to making loans that consumers can, in fact, afford to repay. We do not intend to disrupt the basic underwriting approaches taken by many banks, credit unions, and traditional finance companies, as well as some newer entrants, which offer installment loans in ways designed to assure that consumers can afford to repay them. We believe these lenders will have little difficulty adhering to our proposed rule. In fact, many elements of our full payment test are based on information these lenders have shared about their approaches. But let me be clear. If a lender can succeed when borrowers are set up to fail, it is a telltale sign of a malfunctioning market. When the balance between lenders and borrowers is knocked askew, the win-win dynamic found in healthy credit markets disappears and puts consumers at great risk. We believe the rule we are proposing would make a positive difference by prompting reforms in the markets for these products. Based on our review of the available evidence, we believe the vast majority of borrowers would still be able to get the credit they need in an emergency, either by passing the full payment test or by utilizing one of the other options. But now they would be shielded by an umbrella of stronger protections that would keep them from getting trapped in debt they cannot afford. As we move forward with this rulemaking process, we're also launching a related inquiry into other situations that may harm consumers. Our request for information will help us learn more about a further range of products and practices that fall outside the scope of this proposal. This includes, for instance, further questions about high-cost, longer-term installment loans and open-end lines of credit that lack vehicle security or an account access feature. We will look into the business model for these loans and the underwriting practices of these lenders. We also want to learn more about the extent to which these loans may keep borrowers on a debt treadmill by applying the payments to interest rather than paying down the principal. And we want to know whether these loans encourage loan churning or discourage early loan repayment. What we learn may affect future rulemaking, and it will clearly help guide our continuing efforts to supervise companies and take enforcement actions against unfair, deceptive, and abusive acts or practices. Missouri's own President Harry Truman notably said, "Every segment of our population and every individual has a right to expect from our government a fair deal." Our proposed rule is designed to ensure more fairness with these financial products by making systemic changes to steer borrowers away from ruinous debt traps and restore to them a larger measure of control over their affairs. Ultimately, our objective is to allow for responsible lending while making sure that consumers do not fall into situations that undermine their financial lives. This hearing and the notice and comment process are important steps. We greatly value the feedback we receive, and we study it carefully. It invariably refines our thinking and our approach, and it makes our final rules better in the end. What we hear from you and from all stakeholders will help us decide how we can better protect financially vulnerable consumers. We ask you to share your thoughts and experiences to help us get there, and we appreciate your joining us today. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite the panelists to take the stage. While they're doing so, I will briefly introduce CFPB and guest panelists. David Silverman serves as the Bureau's Acting Deputy Director and Associate Director for the Bureau's Division of Research, Markets, and Regulations. Cheryl Parker Rose serves as the Assistant Director for the Bureau's Office of Intergovernmental Affairs. Daniel Dodd Ramirez serves as the Assistant Director for the Bureau's Office of Financial Empowerment. Our guest panelists are Reverend Dr. Cassandra Gould, Executive Director, Missouri Faith Voices, Carrie Smith, Staff Attorney for Community Legal Services of Philadelphia, Wade Henderson, President and CEO of the Leadership Conference on Civil and Human Rights, Galen Carey, Vice President, National Association of Evangelicals, Darren Anderson, President and CEO of QC Holdings, Keith Saltmeyer, President and CEO, Connecta Federal Credit Union, Bill Himpler, Executive Vice President, American Financial Services Association, and Kirk Chartier, Chief Marketing Officer, Innova. David, you have the floor.
Light's not. Press it again. There it goes. Switch.
Use mine.
Okay, thanks. Apologies. Thank you, Zixta. Good morning, everyone. It's my pleasure to welcome you today to chair this this portion of our field hearing. As Zixta has indicated, we're going to hear from a number of respected panelists today, including advocates from the civil rights, faith-based, and consumer advocacy communities from across the country and at the local level. In addition, we have a broad spectrum of lenders represented, making a variety of different types of loans. Each panel member will give us some background and provide their perspective. We'll then pose questions to our panelists and engage in a discussion. The panel discussion will be followed by the public comments component of the hearing, where we'll hear from members of the public who have signed up to speak. So before I turn it to our panelists, let me take a moment just to frame the discussion. As Director Cordray noted in his remarks, after having studied payday, vehicle title, and what we call payday installment loans over the last 4 years, the CFPB has found that these products often prove unaffordable to consumers, leading to significant consumer harm. Today, the Bureau has issued a proposal that would, if finalized, address the harms flowing from unaffordable payments by requiring, among other things, that lenders determine that consumers have the ability to repay their loans. The proposal would also require lenders to obtain new account access authorization from borrowers after 2 consecutive debit attempts have failed. At our last field hearing on payday lending in March of 2015, we released an outline of proposals under consideration. Since then, we have convened a meeting of small business representatives consistent with the Small Business Regulatory Enforcement Fairness Act, or SBREFA. We've held a tribal consultation, and we've met with a wide range of stakeholders to discuss the proposals we were considering. We've continued our own research as well. We've considered the feedback on the proposals we've put forward and have decided to proceed with a formal rulemaking. The director explained the basic premise of our proposal in his remarks. In short, under the proposed rule we are considering, we would be introducing protections into these markets that would require lenders to determine whether borrowers have the ability to repay, so that fewer consumers fall into debt traps or into loans they cannot afford. So at this time, I'd like to invite our panelists to present their opening remarks. I'm going to ask each panelist to keep their remarks to 3 minutes. Then following the statements, my colleague Cheryl Parker Rose and Daniel Dodd Ramirez and I will moderate a discussion with the panelists. So we'll start from my left with Darren Anderson, the President and CEO of QC Holdings.
Thank you. There you go. Well, thank you, Director Cordray and members of the panel. I'm Darren Anderson, the CEO of QC Holdings. We started our company in Kansas City almost 30 years ago and have grown to become the largest provider of short-term loans in Missouri with nearly 100 retail locations across the state and an annual payroll of almost $45 million across the country. My company proudly offers access to credit that makes people's lives better. I'd first like to make an important clarification. We've heard horror stories in the media about illegal, unlicensed lenders, but it's simply unfair to compare responsible lenders who abide by federal, state, and local laws with the criminal element. Let's be clear, we encourage enforcement actions and prosecutions of outlaw lenders by the Bureau and other authorities. However, the appropriate way to deal with illegal activity is with enforcement action directed at those criminals, not with blanket regulation that would eliminate a significant portion of an already well-regulated industry. Just as you wouldn't get rid of automobiles because of a few accidents, you shouldn't eliminate a source of credit for the majority of folks who appreciate it. What's ironic about today's proposed rules is it will actually decrease consumer protections. The rules contemplate that 70% of licensed lenders will go out of business, but the rules don't presume a decrease in the desire for short-term credit. Indeed, a May 2016 study by the Federal Reserve found that nearly half of all Americans cannot come up with $400 to meet an unexpected expense. With the absence of highly regulated licensed lenders in the marketplace, the CFPB's proposed rules would push consumers to unlicensed illegal lenders. The reality is that the vast majority of payday loan customers understand the product and use it responsibly. Our customers are overwhelmingly satisfied with the product, and complaints about payday loans have been nearly non-existent through the decades of state regulation. Even at the Bureau's own complaint portal, only about 1.5% of all complaints are directed at payday loans, and more than 3/4, 75% of those, are generated by illegal, unlicensed lenders. In the first part of 2016, payday lenders did millions and millions of transactions, but generated only 409 complaints to the Bureau. Payday lending was the only industry with consumer complaints that went down during that period. This lack of complaints, combined with high customer satisfaction survey results, demonstrates that the vast majority of payday loan customers are highly satisfied with the product and do not have problems managing the loan payments. Unfortunately, the CFPB rule proposed, written by a small group in Washington, would preempt laws that have been crafted, debated, and refined over decades by local and state policymakers who know their constituents best. But perhaps most disappointing is the fact that the Bureau's proposed rules do nothing to address the unlicensed lenders who circumvent state law, pose the greatest threats to consumers, and generate the majority of customer complaints and horror stories. Despite its claims of extensive research and being a data-driven agency, the Bureau still cannot answer 3 fundamental questions. 1, why do millions of consumers choose payday lending over other options? 2, why do payday lenders have such a high customer satisfaction rating? And 3, what will replace payday lending when the Bureau regulates it out of existence? Unfortunately, the Bureau has created a rule that will eviscerate the ability of regulated, small-dollar credit providers to serve our customers, driving those customers to more expensive, illegal options, or denying them access to credit altogether and make their lives worse. Our customers overwhelmingly appreciate and value the product because it makes their lives better. They need more credit options, not less. Thank you.
Thank you. Keith Saltmeyer, President and CEO of Connecta Federal Credit Union.
There you go, you had it.
Thank you, Director Cordray and CFPB staff for this opportunity to dialogue on short-term small dollar lending. My name is Keith Saltemeyer, and I serve as President and CEO of Connecta Federal Credit Union and its wholly owned subsidiary, Nix Neighborhood Lending. Connect is a full-service financial institution headquartered in Southern California for 75 years with assets of roughly $4 billion. Our Nix subsidiary has provided alternative financial services to the communities of Central and South Los Angeles for 50 years and has extended short-term small dollar credit for approximately 20 years. Like all credit unions, Connecta is a mission-driven, not-for-profit cooperative that is owned in equal measure by each of its 280,000 members. Our primary objective is not to maximize profits, but instead to improve the financial lives of our members and to provide meaningful benefit to the communities in which they live. As such, we question the need for including credit unions in this rulemaking and encourage Director Cordray to exercise his authority to exempt those with assets under $10 billion. Connecta has a long-standing commitment to serving underserved communities. After 50 years of doing so, we believe that we understand the needs of consumers in these areas and the many challenges that they face. Similarly, we understand the difficulties involved in providing them with affordable short-term small dollar loans. The lending objectives of Nix are to meet our customers' immediate need for liquidity, get them out of debt, build their credit, and position them for lower-cost traditional financial products, hopefully from the credit union, but if not, then elsewhere. Although Connecta is a not-for-profit, we are not a charity. Our capital belongs to our members. Today, credit unions may only grow capital and assets through retained earnings. As our members increase their wealth over time, we cannot accept new deposits without sufficient earnings to support these. Additionally, we cannot invest in the technology and service enhancements necessary to keep up with changes in regulation or the evolving needs of our members unless we earn a reasonable margin on our products and services. In providing affordable small dollar loans, earning a margin has been and continues to be a significant challenge for us. All of our short-term small dollar loans are offered at substantial discounts to market. We provide loans with terms up to 31 days at fees that are 40% less than competitors, as well as installment loans up to 24 months with interest rates capped at 18%. Additionally, payments on installment loans are restricted to be no more than 5% of monthly income. Although we generate sufficient loan revenue to cover variable costs, we have not yet been able to earn a net profit. Scaling this business has been costly and time-consuming, especially given our capital constraints. It has been a slow and at times frustrating process, but the need for small dollar loans in our communities is overwhelming. If responsible, regulated entities are not meeting the need, consumers will go elsewhere, but the need remains. Although we agree in principle with the proposed rule's objectives, we expect that it will be consistent with the Bureau's previous rulemakings in that it increases our costs and/or decreases our revenues. New costs include, among others, gathering, analyzing, imaging, and storing of additional borrower documentation, third-party costs for credit and other data, and costs for designing or modifying our loan origination and servicing systems. When coupled with potentially lower interest income, increased credit risk, and higher servicing costs, we fear that we may be reaching the point at which the credit union can no longer provide short-term small dollar credit and still be seen as a responsible steward of our members' capital. Again, we appreciate the opportunity to share our perspective and experience on this topic, as it's so important to the underserved communities where we do business. Thank you.
Thank you. Next, we'll hear from Kirk Chartier, the Chief Marketing Officer of Enova.
Thank you. Well, I'm glad to be here today representing the customers and the employees of Enova. Enova's mission is to help hardworking people meet their financial obligations, and we're proud to serve the consumers who rely on us for fast access to credit that they can trust. The need for our small dollar loan products is clear. We've already heard about the Federal Reserve research that found that half of America doesn't have $400 for an unexpected expense. Today I'm going to focus on facts, not anecdotes and stories, though I could. We have plenty from our customers about how our products have helped get them through tough times. Enova is a state licensed and directly supervised by states we lend in and the CFPB. We support fact-based regulations that emphasize transparency and fair practices in consumer lending. Companies like Enova are subject to the same laws and regulations regarding loan documentation and disclosures, repayment methods and collection practices as big banks like Citi and Wells Fargo. We don't see more complicated regulations will not necessarily result in a better customer experience or more consumer protection. A second fact, 40% of Americans have non-prime credit scores. Enova can support a simple ability to repay standard that does not unduly restrict access to credit for those borrowers. We believe the final small dollar rule must allow for innovation, must preserve consumer convenience, including the ability for consumers to quickly apply for credit via their computer, tablet, or mobile phone, and receive funding electronically when they need it. They don't expect that getting a $500 loan will have the same requirements as a mortgage. Over the past 12 years, Enova, along with other online lenders, has expanded the availability of mainstream credit products by using individual consumer data combined with advanced statistical algorithmic underwriting to make loan decisions. As you would expect, the default rate and interest rates on these unsecured loans are often higher than those experienced with prime credit consumers. But non-prime consumers still deserve financial access, choices, and flexibility, and that's what our quality products provide to millions of Americans. A third fact, while we're often told that consumers should just borrow from friends and family, recent research from Bankrate.com shows that 63% of Americans don't have $500 in savings, and only 15% can borrow from friends and family. So let's call that the 15% solution. What about everybody else? A final fact. Enova has served over 4 million customers, and our current customer satisfaction scores show 90% of our customers are either satisfied or very satisfied with the service they received. This isn't what critics of our industry want to talk about, but it's supported by the CFPB's own research, showing that a majority of consumers using small dollar loans take 3 or fewer loans in a row and successfully pay those loans off. It is also supported by research published by the Federal Reserve that shows short-term loans can help borrowers avoid more costly overdrafts and defaults on other obligations. All Americans deserve access to quality credit. I think we all agree on that, regardless of income level and despite flaws in their credit history. Enforcement of existing laws, as we have seen CFPB and FTC step up over the recent years, should be combined with reasonable, fact-based rules on ability to repay, lender registration and reporting, and consumer-friendly disclosure to ensure that consumers are being treated fairly. But the rules must not restrict the ability of consumers to access credit when they need it. And that includes making sure that any requirements aren't overly burdensome for consumers, nor create impractical standards that deter lenders from a willingness to make small dollar loans. Our customers will provide comments to the CFPB, we're sure, as will Enova. I hope CFPB will listen and adjust the final rules to eliminate unnecessary restrictions currently in this proposal to ensure that fair, transparent credit remains available for all Americans. Thank you.
Thank you. Next, we'll hear from Bill Himpler, the Executive Vice President of the American Financial Services Association.
Thank you, David. Thank you, Director Cordray and the CFPB staff for inviting AFSA to participate in this important hearing. AFSA represents the traditional installment lending customers and industry, and we've been in business for 100 years, a successful track record over that time. Make no mistake, this proposal before us today could impact access to affordable credit for up to 30% of the population. Kirk said 40%, but somewhere in there. It's a big number. The director has noted that there's a need for high-quality credit and has articulated that CFPB needs actions need to preserve the ability of responsible installment lenders to continue to offer safe and affordable loans. Rather than preserving this ability to offer high-quality products, I'm afraid this proposed rule significantly diminishes that ability. Installment lenders have, for 100 years, a successful track record. Our loan performance is at or above 90%. This rule would subject our customers, teachers, laborers, first responders, to mortgage-like underwriting that just does not work in the small dollar space. Our other option is to offer loans at or below an all-in APR of 36% that was devised 100 years ago. This won't work either. Loans below $3,500 will cease to exist. Millions of good customers will have nowhere else to turn, as my colleagues have pointed out. Banks and credit unions won't make these loans either. In fact, the head of the National Credit Union Administration that regulates credit unions said in response to a 36% rule with the Pentagon that her member companies, the credit unions across this country, are unable to make loans under that regime. So what's the answer? The Center for Financial Services Innovation defined affordable small dollar loans as ones that are based on sound underwriting, a loan structure whereby the loan can be repaid fully without having to reborrow and still meet other obligations and pricing. But the CFSI went on to say that you cannot judge an affordable product just on pricing alone. It takes all three components. The CFSI goes on to define high quality as a matter of balancing both customer protections and lender profitability. As I mentioned, for over 100 years, our members have met this standard. The Department of Justice is even more clear about the virtues of installment lending, and I quote, "Installment loans are closed-end, fixed-rate, fixed-term, and fully amortizing loan products. In a fully amortized loan, both principal and interest are paid fully through scheduled installments by the end of the term. Each monthly payment is the same amount, and the schedule of payments is clear. If the borrower makes each scheduled payment at the end of the loan term, the loan will be paid in full." Again, Department of Justice, installment lenders mitigate credit risk by closely analyzing a borrower's characteristics and ability to repay the loan. And finally, subprime borrowers turn to installment loans when they need cash but have limited access to credit from banks, credit card companies, and other lenders. The products offered by these other lenders are not meaningful substitute for installment loans for a substantial number of subprime borrowers. However, we believe that today's proposed rule is inconsistent with the Justice Department's findings and will severely constrict the ability of responsible lenders to offer safe and affordable installment loans. We work face-to-face with our customers, assess their financial situation, and develop a budget with them. Installment lenders test the ability to repay, as evidenced by the fact that over half of the applicants that come in our stores are turned away because they do not qualify. However, this assessment is done on a case-by-case basis. This rule is just too prescriptive. Installment lenders are not opposed to documenting their assessment, but requiring underwriting that is on par with a 30-year mortgage will not work for the typical installment loan customer. We need greater flexibility in meeting this requirement. Without it, millions of hardworking Americans will have nowhere else to turn. I look forward to the question and answer session, and again, I thank the CFPB for inviting us to participate.
Thank you, Bill.
I'd ask the audience to let the people speak, and nobody needs to be afraid of letting anybody express their point of view here. Thank you.
Next, Wade Henderson, President and CEO of the Leadership Conference on Human and Civil Rights.
Thank you, David. Good morning, everyone. I'm Wade Henderson, President and CEO of the Leadership Conference on Civil and Human Rights, a coalition of more than 200 national civil and human rights organizations dedicated to building an America as good as its ideals. I'd like to start by thanking you, Director Cordray, and your colleagues at the Consumer Financial Protection Bureau for organizing today's hearing and for your efforts to tackle one of the most important economic justice issues facing the nation and most especially communities of color today. The Leadership Conference on Civil and Human Rights believes that the ability to obtain financial services on a fair, equal, and sustainable basis is an essential civil and human right of all Americans. Unfortunately, communities of color and other vulnerable groups have long been subjected to abusive financial practices that have undermined their economic security. They have gone from experiencing redlining and other forms of overt discrimination to, in more recent years, being aggressively steered into predatory and deceptive mortgage and consumer loans, with the end result speaking for themselves over the course of the past decade. We are relieved by the numerous improvements to federal and state financial regulations in the wake of the financial crisis, as well as by the overall change in philosophy that gave rise to the CFPB. And a number of financial services providers do appear to have learned the lessons of the financial crisis. Yet communities of color are still being targeted by predatory lending practices. And this has been especially true in the market for small dollar lending. Payday loans and many other products like auto title loans are marketed as an easy solution to financial emergencies, but they too often fail to work as advertised. Payday lenders argue that they verify that their borrowers can repay their loans, but what they don't do is to verify that borrowers can repay their loans while also meeting their other living expenses. This means borrowers are often left with no choice but to renew their loans at the same high cost and getting trapped and slowly drained of what limited assets they have. Indeed, the very nature of the payday lending business depends on renewals of existing loans. What is just as troubling is the aggressive marketing of these loans to communities of color and other economically vulnerable populations, including older Americans who rely on Social Security. Studies show that payday lenders are heavily concentrated in African American and Latino American communities where access to mainstream banks is limited. And I realize my time is limited now, but perhaps during the discussion, we can touch on postal banking and on modernizing the Community Reinvestment Act as ways to improve access to better financial services. Now, while the Leadership Conference has called for a 36% interest rate cap on loans, as a number of states have done, and as Congress rightly did with respect to military service members, we realize that this is beyond the CFPB's authority. But what the CFPB is proposing today is a very strong, very important step in the right direction. It is a matter of common sense that lenders would ensure that borrowers not simply have enough money to repay their loans, but to ensure that borrowers can repay loans on time without being left in an even worse financial position. In the same way that we require drug companies to show that their cures for disease are safe, we have a moral imperative to make sure that the cures being sold for financial ailments aren't worse than the disease itself. Now, thanks in part to Dodd-Frank, mortgage lenders now utilize common sense ability to repay rules. And today, we applaud the CFPB for applying those rules to small dollar lending practices as well. And we look forward to supporting you in your efforts to protect all Americans, including communities of color, from the scourge of predatory loans. Thank you.
Thank you, Wade. Carrie Smith, Staff Attorney for the Community Legal Services of Philadelphia.
Good morning. Thank you for the opportunity to testify on behalf of our low-income clients at today's hearing. Fortunately for our clients, Pennsylvania has one of the strongest laws in the country to guard against predatory lending, with a strict cap on fees and interest for consumer loans. Pennsylvania residents are among the 90 million Americans, nearly a third of our nation's population, who live in states free of high-cost payday lending and the host of harms it causes. Our law has been effectively enforced against payday lenders operating illegally in storefronts and online, and Pennsylvanians are better off without these unaffordable predatory loans. Likewise, in states where payday lenders once operated but now are banned, research shows that former borrowers were glad to be rid of a product that is the equivalent of financial quicksand, easy to fall into but almost impossible to escape. While high-cost payday lending has never been legal in Pennsylvania, payday lenders have aggressively and relentlessly sought to bring their loans into our state by lobbying to weaken our law. Based on our experience fighting to keep our consumer safeguards in place, we know that payday lenders will exploit any weakness in the national rule as justification for legalizing their loans in our state. In fact, payday lenders already have been using the rule as a Trojan horse. They've been crafting legislation to legalize high-cost, unaffordable, long-term payday loans, claiming that the CFPB gave these loans its seal of approval in its outline of the payday lending rule that it released last March. That's why it's critical that the CFPB adopt a strong rule that sets a high bar to end debt trap lending nationwide. We understand that that's a difficult task, given that the Bureau can't cap the rates on these loans. But the CFPB can go a long way to reining in abuses by making sure that every loan is affordable. We support the fundamental principle of the proposed rule that a lender must ensure that a borrower has the ability to repay the loan without having to borrow again, while still being able to cover living expenses. But we can't support any exceptions to that standard. Payday lenders are notorious for exploiting regulatory loopholes to continue making debt trap loans. In addition, any exception risks sending the message that the CFPB has sanctioned a whole category of high-cost predatory loans as desirable and safe when in fact they are harmful and dangerous to borrowers. Just as doctors take an oath pledging first to do no harm to their patients, the CFPB, our nation's consumer cop on the beat, must ensure that its rule does not put at risk the state laws that currently protect 90 million Americans from predatory loans. Instead, the rule should bolster and support our state laws that prohibit debt trap lending. The rule should provide our states with additional enforcement tools to protect our residents by making a violation of our state's lending laws an unfair, deceptive, and abusive practice under federal law. The CFPB must strengthen its proposal by eliminating exemptions from the ability to repay standard and by building upon our state protections. Given that you don't have the authority to set a national usury limit, states must continue to enact and defend interest and fee caps, the most effective way to curtail predatory lending. A strong national rule coupled with strong rate caps will benefit people everywhere.
Thank you. Reverend Dr. Cassandra Gould, Executive Director of Missouri Faith Voices.
Director Cordray and CFPB staff, I'm grateful to be a part of this distinguished panel representing PICO National Network, which is the largest faith-based social justice grassroots organizing entity in the country, as well as the African Methodist Episcopal Church, the oldest African-American denomination in the country, one born out of social justice. My background is finance. Before entering the ministry, I spent 17 years in finance and the latter part of my career in the banking industry. It was at that point when I first encountered payday lending. And I thought, what in the world? It was shortly after our legislators got rid of our usury law that capped rates at 28%. And so here I saw some of my customers, after losing jobs with car plants and other industry, when TWA left St. Louis and became American Airlines, I started to see customers having their bank accounts overdraft, and did a lot of research to figure out what was going on. And I realized that these customers were in over their head, and was very surprised when I learned that there was very little regulation in the industry, as well as the fact that there was no real underwriting. In essence, what I found is that basically to get a payday loan, all you needed was a checking account and to be breathing. There were really no other real requirements. And it is because of that that many American citizens have found themselves in this debt trap. As I moved into parish ministry in a community of color, pastoring a church in the African American tradition, I became aware of the predatory nature of payday lending. As an African American pastor, I have been targeted by lobbyists when we were in the fight of our lives, trying to get a ballot initiative here in the state of Missouri. Back in 2012, we received letters, that many of you worked on that. We received letters indicating that if we said anything, or if we allowed people to sign the petition, that we could lose our IRS status. And so this speaks to the predatory nature of this lending. It is primarily, as one of the other panelists has said, these lenders target communities of color. They target communities that are already vulnerable, where people are poor. I believe that predatory lending is part of the unholy trinity. It's poverty, financial predation, and poor health that have really become a scourge on minority communities. Predatory lending is like an undiagnosed cancer, and it's attacking every part of the lives of people who we serve in our communities and in our churches. It's not just a moral issue, but it's also a health issue. The debt trap, in my mind, is much like a death trap. It is my job as a person of faith to move people to what the Bible calls the land of the living, and away from wealth extractors who are operating under the guise of payday lending. One of my favorite scriptures in Proverbs says, "Do not rob the poor because they are poor." And so, while I think that these rules are certainly a step in the right direction, what we need is very strict underwriting guidelines. There need to be no exceptions, no opportunity for predatory lenders to find the loophole, which will ultimately harm the people that are already the most vulnerable citizens. We must stop the debt trap with a strong rule that eliminates these loopholes and also has strong protection against loan flipping. It really is a matter of life and death for the most vulnerable citizens in our state and in states all across the country. Thank you.
Thank you. Finally, Galen Carey, Vice President of Government Relations for the National Association of Evangelicals.
Thank you, Director Cordray, and my fellow Americans. When used responsibly, credit can be a blessing. Banks, credit unions, and other financial institutions play a vital role in the efficient functioning of a modern economy, contributing to the common good. The Bible offers these guidelines for honorable lending and borrowing. 1, don't take advantage of the vulnerable. 2, don't charge excessive interest. 3, lend generously. 4, avoid unnecessary indebtedness and default. 5, forgive debts that cannot be repaid. 6, bear one another's burdens. and 7, seek the common good. When evaluated against these criteria, the current predatory payday and car title lending system falls far short and must be judged unacceptable. An industry that targets vulnerable people with a product that leaves many of its customers worse off does not contribute to the common good. The National Association of Evangelicals brings together 40 evangelical denominations with more than 45,000 congregations, millions of constituents, and we have seen the devastation that predatory lending has wrought in too many communities. In 2014, the NAE adopted a resolution calling on the CFPB, quote, to investigate predatory lending abuses and to establish just regulations that protect consumers, particularly the most poor and vulnerable, from exploitation. We are grateful to the CFPB for heeding this call and for proposing a rule today that attempts to rein in some of the worst abuses. We hope that the final rule will be strengthened to be free of loopholes that lenders may exploit to continue abusive practices. We look forward to studying the rule and offering input during the comment period. The NAE has joined with other faith-based organizations to establish Faith for Just Lending, a broad coalition including many represented here today. Our statement of principles, which is available at lendjustly.com, calls on government to prohibit usury and predatory or deceptive lending practices. In partnership with Lifeway Research, we conducted a national poll of evangelicals who live in the 30 states that allow predatory payday and title lenders to operate freely. We found that 94% agree that lenders should extend loans at reasonable interest rates and based on ability to repay. 86% believe that laws or regulations should prohibit lending at excessive interest. And 80% believe that laws or regulations should protect borrowers from loans that cannot be repaid. While today's rule is an important step forward, addressing underwriting standards and abusive loan frequencies, the CFPB is statutorily prevented from undertaking one of the most needed reforms, an interest rate cap that would prohibit usury. That is a role that falls to Congress and to state legislatures. Through the Military Lending Act, Congress has already instituted a 36% rate cap on loans to service members. Congress should extend this important protection to all Americans. States that do not regulate interest rates can learn from the example of those that do. For our part, evangelical churches will continue to provide charitable assistance to those most in need, for whom loans of any kind are inappropriate. And we'll continue to advocate for fair and just regulation of loans so that when credit is made available, it is offered under terms and conditions that allow borrowers to resolve their problems rather than become more deeply mired in them. Thank you.
So I want to thank all the panelists for their thoughtful and forthright remarks. Cheryl, Daniel, and I will now ask the panelists some questions to try and generate some interesting dialogue. And I'll take the prerogative of asking the first question to Keith Saltemayor. Keith, can you talk about some of the products that exist in the marketplace that provide access to credit?
Yes, sir. So several studies show that a great many U.S. households lack some substantive savings, and during any given year, they're either temporarily or habitually illiquid. This is consistent with what we see in Los Angeles. Because 60% of all jobs in the U.S. are paid hourly wages, income volatility is common. And when coupled with illiquidity, this is one of the biggest challenges that low and moderate income households face. The problem is often exacerbated by damaged or thin credit files, which limit their access to traditional forms of credit, like credit cards or lines of credit. Because most of their income is used to cover basic needs, quite often they must borrow when unexpected things happen, like a car repair or medical bills or a smaller paycheck. To address these cash shortfalls, many families use short-term credit products such as payday, auto title loans, pawn shops, workplace loans, cash advance options, and installment loans. Failure to do so exposes them to a litany of penalties, which are usually more costly, like late fees on loans and utility bills, reconnection fees for essential services like water and power, and overdraft charges on checking accounts. Today, Connecta members with damaged or little credit may choose from single payment loans for up to 31 days, installment loans up to 24 months, and secured credit cards. Each of these comes with a savings account, and Connecta funds the first $5 deposit. Additionally, we have a payday payoff loan that allows consumers to consolidate up to 3 payday loans or any other high-cost debt and pay these off over time at 18% interest. Similarly, we have a citizenship loan that allows people wishing to become citizens of the United States to finance the $680 in fees and charges over time. We've helped over 12,000 families with these loans so far.
Cheryl Parker Rose has the next question.
Thank you, David. My question is for Reverend Dr. Gould. Can you tell us, for your parishioners who are in financial distress, what's been their experience with small dollar loans?
Thank you. I have talked to not just parishioners, but many people in the community. And one of the stories that I'm just reminded of is a professional woman by the name of Waltrina, who shared with me getting a loan to make a car repair and not being able to pay off the whole loan in the allotted time, and having her bank account debited 15 times in one day, which then left no money when her paycheck hit, which led to losing her apartment. And so what I am seeing is people that are struggling because of the lack of underwriting and because of predatory lenders not looking at the whole picture. It's not just if you have the income to repay, but what your other obligations are. And so that has been a common theme that I've heard over and over and over again. One of the panelists mentioned about the low percentage of people that report problems with payday loans, and I believe that that's because of the shame element. There is a level of shame that exists. People, and that really speaks to kind of this seedy nature of the predatory lenders. People don't want people to know that they've had one of those loans. And so, no, they don't report the abuses. But in pastoral care, we find that out. Many of the calls that we get on a monthly basis, we're tracking why they got into the situations they are in. Every now and then, someone is asking, can you help me get out of this loan? Not only am I in threat of losing my home or my car, but I'm about to lose my mind. There really is an emotional and a physical side effect of it. But when we analyze how they got into it, sometimes even when they're asking for a payment for a utility bill, it is because the payday lender has basically left them with nothing because of the continuous debt extractions that come from their accounts. And so there has to be, and I'm grateful that the rule speaks to no more than 2 of those extractions in a day, but there has to be really strong underwriting. I cannot say that enough, that eliminates the loopholes. And I'm also reminded of Sharon, who had 5 loans, and each loan was designed to pay off the last loan. And so that cannot happen. There has to be a limit on the number of loans that a person can have, and 6 is way too many.
Daniel Dodd Ramirez, the next question.
My question is for Darren. Darren, are there particular challenges to assessing a consumer's ability to repay?
Yeah, thanks. Like all lenders, assessing ability to repay is very important and challenging. Our product in particular makes it challenging because the loans are so small and short in duration. A 2-week period of time makes it difficult to find information that's predictive on repayment during that short period of time. And the size of the loan and the fees on those loans make it somewhat cost prohibitive to spend a lot of money to acquire that information as well. So we, over the last 20 years of operations and doing millions of transactions with thousands of customers, have developed a model to help us understand who we think can pay us back and at what period of time. For those who can't pay us back, we've developed extended payment plans. So they have a safety valve if they feel like they can't pay us back to get more time at no additional cost to pay those loans back. I believe those two things have helped us, generate 95% of our customers eventually pay us back over time.
Terry, in your experience, what is the impact on local communities if small dollar loan products are offered or not offered?
Sure. Well, we know that harmful small dollar loan products, such as payday loans, are disastrous for individuals and communities. Although Pennsylvania has never legalized payday loans, payday lenders have employed a variety of schemes to set up shops in our communities. And victims report heartbreaking stories, confirming what research has shown. Payday lending leads borrowers to fall behind on other bills, their rent and their mortgages. It causes them to overdraft and eventually lose their bank accounts. And payday lending also has an impact on communities, creating strains on food pantries and charitable relief services. Unfortunately, courts and regulators effectively stopped the debt trap in our state, bringing relief to consumers and communities. But having once seen the harms of payday lending, we now have a diverse coalition that's working very hard to keep our strong state law in place. Like Pennsylvania, 13 states and DC have concluded that their communities can best thrive without harmful debt trap products. And studies from across the country, from North Carolina to Arkansas, show that borrowers are better off with strong interest rate caps in place. That's why we need the CFPB to reaffirm state interest rate caps and do everything it can to build upon state protections and not undermine them.
Kirk, what technological improvements are needed to determine a customer's ability to repay? And I have a second part to the question, please. Have you used technology to enhance your product in the marketplace?
I'm actually going to take the second part first, maybe. Our technology is pretty advanced already. Our technology lets consumers apply securely online over their phone or their computer, lets us then access third-party data almost instantly in order to fill in information on that application or to start our statistical algorithmic assessment of that application. And what we try to do is we'll take that information, look at the history of the individual so that we can make a judgment on, one, are they being accurate in the information they're presenting, and two, from their past payment history, is it likely they'll be able to repay going forward? And we use that then to match against our database of the 4 million customers to match that up to figure out who it is that we think is most likely qualified and able to repay. That's a very important part. It's good technology. Those are the things that we put in place, and we were one of the leaders in online lending and bringing that statistical approach. I would say what could make it better, obviously, is going to be data. We need more data. Data access to bank transactional records is really important to us. Unfortunately, under pressure, one of those products was removed from the market last year, and that hasn't helped us. We're going in the wrong direction. We're taking data away from companies like ours instead of adding to it. So more access to bank transactional record data, that'll be very helpful. The other thing is when we go to access credit reporting history, the big guys with the best technology, the big CRAs, don't allow us to report. They don't like to have non-bank lenders reporting to them. And then the smaller proprietary systems that the state have in place aren't very accurate, and they don't have access to the main CRA systems either. So a better reporting infrastructure to support us as well so we could pull down data and push data up. I think those are the two big things that could help improve it.
next question is for Wade. So Wade, will assessing a borrower's ability to repay address the biggest challenges facing consumers in the small dollar lending market?
Thank you. Look, this will be a tremendous step forward in eliminating some of the most troubling practices from the marketplace, but it may not address problems caused by upfront fees and flipping an installment loan market. But a strong final rule that applies without exemptions and loopholes will really go a long way toward addressing the problem. Now, that said, the communities that are currently being targeted by lenders still have a troublingly low level of savings and a lack of access to traditional banking services. So the more we can do to address that problem, the more we can do to reduce their vulnerability to predatory lending practices. Now, the one thing that I and others like Senator Elizabeth Warren have called for is to engage the U.S. Postal Service in providing banking services. This is an institution with a very long history of providing well-paying jobs and building trust in the community and serving everyone's needs who comes through their doors. And if it could provide a range of low-cost financial services as well, either on its own or through partnerships with existing banks to help them, to bring them into the neighborhoods where they once were, I think we could address the problem. And then lastly, I'd like to also take another look at modernizing the Community Reinvestment Act to make sure that it's keeping up with the rapid growth in technology and giving banks the strongest incentive to reach underserved communities. There will continue to be a need for public education. And a little over a year ago, we undertook a research project on how to talk to communities of color about financial matters, and we shared it with credit counselors, the Bureau's Division on Consumer Research, and other parties, and we'd like to do more of that research, but I think all of those things are necessary to really address the problem.
So for Bill Himpler, Bill, what are your thoughts on the effect of small dollar products on consumers?
Well, thank you, David. I think it's critical to paint an accurate picture of what this rule will result in. We've already heard how the provisions of this rule will cripple, if not kill, payday and title. The director of NCUA has said that her credit unions cannot make the loans in an affordable fashion that have been prescribed as an alternative in this rule. At the end of the day, you have to have somewhere for folks to go to meet their credit needs. Installment lending has been around for 100 years. We were created to serve this need. We have over 90% performance in North Carolina alone, and it goes to what Kirk said about data. In 2013, 2014, and 2015, installment lenders made $1.6 million loans, totaling $5 billion in loan activity. And on average, there were 15 complaints in the state of North Carolina. It just doesn't add up. The options that are afforded to the installment lending industry is to either employ mortgage-like underwriting that won't work, or try and fit into a 95% performance in conjunction with the 36% rate cap. Add to that, and probably most troubling, is the fact that there are new UDAP provisions in this rule. So let me paint a picture for the folks in the audience and for the folks that are watching at home that happens every day in communities across this country in installment lending branches. Lisa comes into one of our branches, and I'm there, I'm the lender. She's there with her little daughter of 5 years of age. I know her family, but I don't know her really well. She needs $2,000 to get out of an abusive situation. Under the current structure, I might take a risk on her because I know her family. I know her, I don't know her really well. But with the restrictions that are incorporated in this rule, I can't afford to take a risk on Lisa, because if I get it wrong, I am going to be punished. There's no incentive. As I mentioned earlier, the Center for Financial Services Innovation has laid out standards and guidelines for small dollar lending. And they said at the end of the day, what we need is to align consumer protections and lender profitability so that they can work together. Under this rule, millions of Americans, just like Lisa, 9 out of 10 that are already performing in the installment lending community will be out of luck.
My last question is for Galen. Galen, what have you seen with respect to a consumer's ability to repay a small dollar loan in full without having to go back to the lender to refinance or reborrow?
Well, about 3 out of 4, something like 76% of all payday loans occur within 2 weeks of a previous loan. And on average, borrowers take out about 10 of these loans per year. So it appears that payday loans are actually structured to avoid the possibility of successfully being repaid without additional borrowing. In fact, in some cases, the first loan is offered as a loss leader at free or reduced interest in order to lure customers into the trap. And around Christmas time, we see an uptick in advertising for these kinds of loans, trying to attract people needing Christmas money. There are exceptions, but most people who desperately need $400 today will not miraculously have an extra $450 2 weeks from now to repay their loan, the fees and the interest, and to meet their ongoing current expenses. So what makes refinancing so entrapping is the high interest rate. If interest rates were reasonable and payments over an extended time were allowed, the burden would still be challenging, but more likely manageable. But with triple-digit interest and lump sum repayment, it's nearly impossible to meet the demands of the loan without reborrowing. In fact, in some cases, the interest and fees, as well as the principal, are rolled over into a new loan, so that there's actually a snowballing debt that gets larger and larger until it's destroyed the borrower and oftentimes their family. And we've seen cases where families have actually been destroyed in careers by the debts. This is why we hope that the new rule not only has strong upfront underwriting requirements, but also effective back-end protection against repeated flipping of the loans.
So one final question for all our panelists. Can you talk about what you think is the right balance between access to credit and consumer protection in this space? And we'll go in the same order in which we did opening statements, starting on my far left.
Thank you. Access to credit is extremely important. I wouldn't be here today if someone didn't give me money and loan me money to go to school. So access to credit is, I believe, makes people's lives better. I see it frequently when I see our customers who, with a few $100s, solve extremely important issues for them. We saw the study that says that people don't have $400 saved up to cover short-term expenses. But even with that huge demand, I think there needs to be strong consumer protections in place. It needs to be a highly regulated, licensed industry that's audited and examined. There needs to be a viable complaint system where consumers can voice their concerns and get those resolved and solved. I believe there needs to be an ability for consumers to get additional time to pay back their loans if they need it. And I believe there needs to be fair professional collection efforts. I believe things like this will help the product still exist and not go away. Consumers need more credit options. They don't need fewer. Thank you.
David, how much time will I have to respond? Yeah, I don't know. I think I was inadvertently cut off on my last statement, so I just want to make sure I keep it in within the time frame. I mentioned that we have products like the Payday Payoff Loan and Citizenship Loan, where we allow our consumers to consolidate other high-cost debt and term it out over 18%. It's regrettable that it appears that these loans are invalidated under the current proposed rule. Though admittedly, it was released last night, so this assessment's kind of based on only a preliminary review. I'm certainly appreciative that the CFPB carved out the NCUA's payday alternative loan from the rulemaking. We have significant experience with this product. To my knowledge, we are the only credit union that has offered this loan at scale to a predominantly payday loan audience. We promoted the payday alternative loan for nearly 2 years in our 35 NICS stores. Given its restrictions and terms, it was widely rejected by our borrowers. For the 1,920 loans that we did originate, the credit union lost approximately $21 on every loan. We hope that other lenders will try it in their markets and enjoy better results. However, this is not a viable product for Connecta. So throughout this rulemaking process, we've analyzed mountains of data, we've issued white papers and funded studies on both sides of the argument. It really shouldn't surprise us that those with opposing views examine the same data set, yet can support vastly different conclusions. I believe it's called lies, damn lies, and statistics. What's troubling to me is that in none of these do I see the voices of the most relevant participants in the industry. What a consumer suggests is the appropriate trade-off between access and consumer protection. I suggest the next study focus on answering this question. The truth is, I don't know what the right balance might be, but because we are again asking industry insiders and consumer advocates, we should expect the answers to range from unfettered access to absolute abolition of payday lending. As usual, the proper response is probably somewhere in between. Excessive regulation will eliminate the short-term small dollar lending industry, and it appears with this proposal we're headed in that direction. However, try as we may, we will not eliminate the need for these products. The right balance between access and consumer protection is one that encourages the existence of a healthy market where licensed and regulated providers, both large and small, compete. If we get it wrong, the alternative will see the need met by unlicensed, unregulated entities, and in this environment, consumer protections will be few or non-existent. Thanks.
You know, what is the right balance between access to credit and consumer protection? I think, you know, the right balance is one that increases consumer success and reduces potential consumer harm without unduly restricting access and availability to small dollar credit. Rules that protect consumers are good. Enova has long been a champion of these types of regulations. That includes things like requiring transparent disclosure of terms, preventing abuse of collection practices, and ensuring lenders are doing the right things in terms of validation of key pieces of consumer information like income and expenses. What tips the balance much too far and isn't good is telling people they can't take out a loan or making arbitrary rules that restrict access to credit. Placing that type of burden on the millions of Americans who are depending on this access to credit helps no one. We believe non-prime consumers deserve to have access to the same types of products as prime consumers have, with the same set of choices and protections.
First off, I want to again thank the director and CFPB for inviting us to participate. This is a very important hearing. I was struck by Galen's comment at the end there about a $400 payment that's due. Installment lending doesn't work that way. Our average loan size is $1,500. It's 12 to 15 months, sometimes 18 months, and the average monthly payment is $135. If somebody makes that payment, through the term of the loan, that will be paid off. And that's very important, very critical for many Americans in the space that my colleagues have been talking about. I think in terms of the balance, The outline provided by the Justice Department, I think, is a great start. Also, as I mentioned, the Center for Financial Services Innovation that talks about balancing or aligning the incentives of lenders with the consumer protections. We work one-on-one with our customers in the branches, assessing their unique situation. And we are talking about folks that you can't just do a cookie-cutter approach. We work very hard to make sure that we assess those needs and structure the loan in a fashion that they can repay it without having to reborrow it. But this rule, as proposed, could upset that balance for millions of Americans that are at risk. What we would like to see is a rule that puts forward clear empirical evidence as to the harm, and we've talked about the lack of evidence here today, and evidence that the proposal will effectively address that harm before we roll the dice on millions of Americans.
Thank you, David. I think striking a balance is really very important. For me, the balance lies in whether a product is likely to leave consumers in a better or at least the same financial position that they were in before, or whether it puts them in even greater distress. Now, balanced regulation backed up by careful research means giving borrowers every chance to succeed with a suitable and affordable loan at the outset. What the CFPB is proposing today is a step in the right direction. That said, I urge the Bureau to listen to the comments from communities across the country, particularly those in states that ban payday or car title lending outright, about how they're striking a more appropriate balance. I also believe that driving out bad forms of credit can actually increase both the supply and demand for more responsible forms of credit from lenders that might take more time than those who offer fast cash. So it's important to cut off access to the most destructive forms of credit in its own right, while giving responsible lenders the opportunity to engage in this market in a way that helps the communities in which they serve.
I think 14 states and DC have struck the right balance with rate caps for small dollar loans, and the Department of Defense agrees. In its report evaluating the Military Lending Act's 36% all-inclusive rate cap for loans made to active duty military, DoD concluded that it had established a balanced approach in using the regulation to curb products with demonstrated high cost and predatory features. Now, I understand the CFPB can't issue a rate cap, but it can help achieve the right balance by ensuring a strong ability to repay standard that prevents lenders from ensnaring borrowers in unaffordable debt from which they can't escape. That means no free passes or safe harbors for poorly underwritten loans. Business as usual payday loans must end. Payday loans are not helpful credit. In fact, payday loans, whether they're traditional balloon payments or the longer-term payday loans that they're increasingly migrating to, they deepen financial distress for the typical borrower. They are the equivalent of throwing a leaded anchor to a drowning man. The right balance in the payday lending space is to prohibit these unfair and deceptive practices through rate caps, as states have done, and through an ability to repay standard with no exceptions.
When answering the question about the balance between access to credit and the harm that predatory loans have caused and is causing Americans, I recognize that all credit is not equal. There is credit that is morally sound and credit that does not do harm, and there is credit that is destructive. And so as the Bureau goes forward, again, echoing the sentiments of some of our panelists, it must go forward in holding a standard that ensures that Americans are not harmed. In Flint, water was a good thing, but having access to water that was toxic was detrimental and caused much more harm than it did good. And in many cases, the kind of loans that are given by predatory lenders is equivalent to the water in Flint.
So access and consumer protection, rather, should not be seen as competing values on a continuum. Access is only valuable if the credit that is offered is beneficial. Access to debt traps is not a benefit to be balanced against other values. Access to debt traps is like a sewer hole that it has a missing cover. What's needed is to replace the cover so that the unsuspecting pedestrian does not fall into the sewer. Whatever the financial crisis that leads someone to seek emergency credit, predatory payday or car title loans add to the crisis and often create a new emergency by saddling the consumer with unaffordable debt without providing a manageable repayment schedule. And of course, this wouldn't include loans that go on for a longer time. But we have seen marriages, families, and careers all destroyed by predatory lenders. Effective consumer protection should establish guardrails that keep people who face emergency needs from falling off a financial cliff. Someone who's driving on a treacherous mountain road does not need access to the ravine below. Someone who's sick does not need access to poison. Access itself, it can be a red herring that obscures the fundamentally flawed nature of some predatory loan products. Protecting consumers means assuring that the financial products on offer actually serve a useful purpose, that the terms and conditions are transparently presented, and then they can be reasonably repaid by the borrower without undue hardship and without the need of a new loan to pay for the principal and interest on the original loan borrowed.
So this concludes the panel portion of our program. Please join me in thanking all the panelists for a thoughtful and provocative discussion. So at this time, I'll invite the panelists to join the audience if they so choose, and turn the program back to Zixta Martinez, our Associate Director for External Affairs, who will moderate the next portion of the field hearing. Thank you again.
Thank you, David. Please give our guest panelists another round of applause. They were really terrific. Thank you.